So, what happens when a pillar of the world's second biggest economy starts to look a little shaky? We're talking about China's absolutely massive property market. In this explainer, we're going to dig into how a crisis there isn't just a local issue, it's a potential shockwave that could be felt all around the world. Here's our game plan. First up, we'll get a handle on just how big this property giant really is. Then, we'll look at the cracks in the foundation that make it so prone to bubbles. We're going to simulate an economic shock, watch the dominoes fall inside China, and then trace that ripple effect as it spreads across the globe. And finally, we'll wrap it all up as a cautionary tale about economic risk. All right, let's dive right in. To really understand the risk, you first have to grasp the sheer scale we're talking about. This isn't just another industry, it's a core pillar, a foundational piece of the entire Chinese economy. Let's just start with one number, 25%. That's a huge figure, right? But what does it actually mean? Well, this chart here puts that number in perspective. It means a full quarter of all the money being invested in fixed assets, things like factories, machinery, buildings. It all flows directly into real estate. Just look at it. That's more than the entire manufacturing sector. It's bigger than mining and utilities put together. It is by far the single biggest slice of the investment pie. Okay, so when you have a pillar that large, you'd hope it's built on solid rock. But the thing is, there are certain structural features in China's economy that have created a system that's just inherently unstable and prone to bubbles. So how does this happen? Well, it's kind of like a perfect storm. First, you've got low interest rates, which makes borrowing money really cheap. Second, the financial system isn't fully developed, so for regular people, there aren't many great places to invest their savings other than property. And third, a closed capital account means most of that money is essentially trapped inside China. So what's the result? A massive flood of cash into real estate, which fuels overinvestment and creates this constant risk of a speculative bubble. Now, of course, the Chinese authorities know this is a huge risk, so they're engaged in this incredibly delicate balancing act, trying to cool down the market without causing a full-blown crash. They use what are called quantity-based tools, like making it harder to buy a second or third home, and they slap credit limits on property developers to try and keep things from getting out of hand. But what if that balancing act fails? What if the tightrope walker slips? To figure that out, economists do what they do best. They run a what-if scenario. They build a really complex model to simulate a sudden crash in real estate and then trace where all the pieces fly. The tool they use for this is called a factor-augmented vector autoregression model, or FAVR. Yeah, don't worry about the jargon. The best way to think about it is like a superpowered economic weather forecast. It takes in hundreds of different data points at once to predict how a storm starting in one place, like China's property market, is going to spread and affect the entire global system. And when I say it processes a lot of data, I mean it. Just look at this table. The model is tracking 68 different variables for China and 322 for the rest of the world's biggest economies. We're talking everything from industrial production and credit supply to trade flows and housing prices. It's essentially creating a live, dynamic map of the entire global economy. Okay, the simulation is running. The shock hits. So let's follow the immediate fallout as the first dominoes start to fall right there inside China. The first and most obvious casualty is the construction industry. And this is a huge deal. That one sector all by itself makes up a massive 7% of China's entire GDP. And why does that 7% matter so much? Because construction isn't an island. It has what economists call deep, backward linkages. Put simply, to build stuff, you have to buy a ton of other stuff from other industries. So when construction grinds to a halt, the order books for all those other businesses suddenly go empty too. It creates a chain reaction. And this chain reaction smacks some of China's most vital sectors. The mining industry gets hit hard as demand for things like iron ore just evaporates. Manufacturers making metal products, construction materials, heavy machinery, they all see their orders dry up. The entire industrial supply chain feels the pain. So that's the fire starting at home. But in our completely interconnected world, economic fires don't really respect borders. Now, let's zoom out and see how this problem spills over, creating a global ripple effect. The simulation gives us some really specific and, frankly, pretty sobering numbers. The key finding from the whole analysis is this. For every single percentage point drop in China's real estate investment, but the impact within the first 12 months is pretty significant. China's own GDP gets shaved by about 0.1%. And check this out, total global output falls by 0.05%. And because China's construction boom is what drives so much demand for raw materials, global metal prices could fall by as much as 2.2%. That's a direct hit to any country that exports commodities. And what's really interesting is that this pain isn't spread evenly around the world. The model shows that countries like Germany, Japan, and South Korea, industrial powerhouses whose supply chains are deeply tangled up with China's, they would be among the hardest hit. On the other hand, economies like the UK and the US seem a bit more insulated from the initial shock. So, what's the big takeaway here? The numbers are important, for sure, but the real lesson is about understanding a specific kind of danger that exists in complex systems. It's called tail risk. The source analysis puts it perfectly. A collapse is seen as a low probability event, meaning it probably won't happen. But if it did, the impact would be sizable, with large spillovers. And that, right there, is the classic definition of a tail risk, an event that's really unlikely, but would be absolutely catastrophic if it ever came to pass. Now, it is so important to understand this. This analysis is not a prediction. It's not a crystal ball saying a crash is right around the corner. Think of it more like a stress test for the global economy. It's designed to find the hidden cracks and vulnerabilities in the system to show us exactly what's at stake before something actually breaks. And that really leaves us with one final huge question to think about. In a world where a housing slump in one country can shake commodity markets and shutter factories thousands of miles away, is it even possible anymore for a major economic crisis to ever be just a local problem?